How leveraged is South Korea's stock market? Let's start with a number most people missed. Over the past 12 months, South Korean stocks rose more than 120% while semiconductor exports hit a record. At the same time, the won stayed stuck between 1,450 and 1,500 to the dollar, near its weakest level since the 1998 financial crisis. Stocks doubled, yet the currency did not budge. That is highly unusual. Exchange rates do not lie. The one was already telling you that money kept flowing out. On July 28, the KOSPI plunged 10.84%, broke below 6,000 and triggered a circuit breaker. It was already 36% below the record high set 1 month earlier. Many people asked when foreign selling would end and when to buy the dip. To understand this sell-off, first ask two questions. Whose leverage made it fall so fast, and what determines how far it falls? First, leverage. On June 24, margin financing at Korean brokerages reached a record 38.63 trillion won. It was 27.42 trillion at the start of the year and only 20.79 trillion 1 year earlier. Deleveraging then began. By July 27, the balance had fallen to 32.74 trillion won, down about 5.9 trillion or 15% in 1 month. By market, the KOSPI balance fell 13%, while KOSDAQ was down nearly 38% from its late April peak. Unsettled short-term margin debt also fell below 1 trillion won for the first time in 3 months. Deleveraging is real and KOSDAQ has cleared more aggressively. Still, 38 trillion won is less than 0.5% of a market worth roughly 8,000 trillion, so the headline total is not high. The real problem is not the total, it is the structure. Korean brokerages typically require a 140% maintenance ratio. Below 140%, investors have 2 business days to add collateral. Below 130%, forced selling begins the same day. Forced sale orders are often priced 15% to 20% below the previous close. To cover one collateral shortfall, a brokerage may sell 4 to 7 times the size of the gap. That is why Korean leverage fears consecutive plunges far more than a slow decline. In June, forced liquidations averaged 52.7 billion won a day, 7.4 times the daily average for 2025, and that is not the whole story. The Bank of Korea puts margin loans, unsettled credit, and leveraged ETFs at nearly 75 trillion won combined. Leveraged ETFs are this year's new variable. After 2 times single-stock ETFs on Samsung Electronics and SK Hynix launched on May 27, retail investors bought about 8.2 trillion won in less than 1 month. These products buy into gains and sell into losses. They do not create direction, they amplify speed. The July 28 crash was a full demonstration of this mechanism. Samsung Electronics fell 13.39% and SK Hynix fell 14.65%. Foreign investors sold about 4.98 trillion won while retail investors bought roughly 4.32 trillion. Now, foreign investors. From January through May, they sold a net 114.22 trillion won of Korean stocks, more than 10 times the total for 2025. Yet the value of their holdings rose from 1.701 trillion to 2.852 trillion won, a record 35.3% of the market. The stocks they kept rose even more. The 114 trillion sounds huge, but it is only 4% of their 2.852 trillion won holdings. Foreign investors have not truly reduced their exposure to Korea. Cutting the allocation by just 1 or 2 percentage points could still unleash tens of trillions of won in selling. Will foreign investors buy the dip? I think buying the dip is the wrong way to describe them. Foreign capital is not one account making one decision. In May, U.S. investors sold a net 28.9 trillion won. In the same month, investors from Norway and Hong Kong were net buyers. Foreign flows are the combined result of hundreds of accounts with different constraints. Much of this selling was not bearish at all. The more a stock rises, the larger its weight in a global portfolio. Even bullish managers can be forced to sell by risk limits. This is mechanical, and the reverse is also true. When Korea's weight falls below the benchmark, index funds must buy it back. That is not dip buying, it is arithmetic, and it is already happening. On the morning of July 29, foreign investors turned net buyers, but only by about 238.6 billion won, equal to 5% of the previous day's selling. That is testing the water, not a reversal. The real trigger for large-scale inflows is the exchange rate. Remember the anomaly: stocks doubled while the won stayed flat. Korea's trade surplus was offset by capital outflows. Retail leverage can push up share prices, but the exchange rate cannot be fooled. Over the past 2 weeks, the won strengthened to 1,469, its best level since May. But look at what drove that strength. It was not foreign equity buying. It was exporters converting dollars into won. In the first 20 days of July, semiconductor exports surged 186% year-on-year to a record, accounting for 40% of total exports. Exporters converted dollars into won, supporting the currency. That is the problem. Semiconductor exports support the won, while doubts about the semiconductor cycle are hitting Korean stocks. They are the same engine. If the memory cycle weakens, export conversions shrink and the won falls just as stocks are declining. For dollar-based investors, both the stocks and the currency lose. The two risks do not diversify, they compound. That is why foreign investors are in no hurry even when prices look cheap. Oil is another link. On July 24, the US-Iran conflict pushed Brent crude above $100. The KOSPI fell 5.72% that day. Oil raised inflation. Korea's June inflation hit 3.2%, the highest in 2.5 years, forcing a rate hike. On July 16, the Bank of Korea raised rates unanimously for the first time in 3.5 years. Higher rates support the won, but they also raise financing costs. Margin rates already at 8% to 10% become even harder to carry. My conclusion on foreign investors is simple. Small mechanical repurchases will continue, but they are only rebalancing noise. The real signal is the exchange rate. A decisive break below 1,450 toward 1,400 would mark large-scale inflows. A move back above 1,500 would mean even exporter conversions are weakening. Watch the won, not the daily foreign flow figures. Finally, the AI narrative, because it determines how far Korean stocks can fall. The July 28 trigger was NVIDIA providing a $250 billion financing guarantee for OpenAI's data center investment. The market's interpretation was simple. The chip seller is financing the chip buyer. The concern is reasonable. When a supplier finances customer purchases, revenue quality becomes difficult to assess. Around 2000, telecom equipment vendors financed the carriers buying their equipment, and that is how trouble began. But the counterargument also holds. Cloud companies fund capital spending mainly from operating cash flow, and cloud revenue is real revenue. It is not a completely closed loop. So is AI a bubble? There is no answer yet, and the answer will not come from Seoul. For Korea, the question is narrower. Its index is centered on two memory chip companies. Their profits depend not on the AI narrative but on memory contract prices and capital spending guidance from a handful of buyers. The evidence is already arriving. SK Hynix's second quarter results missed expectations. That is not narrative. It is data. My view is that the AI story does not need to collapse for Korean semiconductor valuations to fall. It only has to stop accelerating. A stock priced for continuously accelerating capital spending will fall even when spending merely levels off. Do not chase bubble debates. Track memory contract prices and cloud capital spending guidance. The first can be tested within weeks. The second can be argued forever. How do we judge a bottom? Many people watch margin balances, but there is a trap. They fall fastest precisely when the market is falling hardest. Forced selling and debt repayment naturally reduce the balance. A falling balance is not a stabilization signal. It is part of the crash itself. What matters is the pace. The balance fell by 5.9 trillion won last month. If the weekly decline slows to a few hundred billion, most forced positions are likely gone. Another 2 or 3 trillion in 1 week would mean liquidation is continuing. A drop in daily foreign selling from 4 or 5 trillion won to a few hundred billion matters more than 1 day of net buying. Forced selling dropping from about 50 billion won a day to only a few billion matters more than the remaining balance itself. Watch the change, not the level. These events will not happen at once, and they do not need to. At market bottoms, deleveraging is usually unfinished and earnings forecasts are still falling. Waiting for every condition to be met means missing the move. Current data show that leverage is adjusting faster than fundamentals. Margin balances are down 15%. Cost stack is close to being cleared out. Unsettled debt is below 1 trillion won. Much of the pressure has already been released. But memory prices, oil, and capital spending expectations are only beginning to be priced in. The second half of this Korean market sell-off is no longer Korea's story alone. Leverage determines the speed of the fall. Other people's spending plans determine the depth. And the won will signal returning money before stock prices do. This is personal analysis, not investment advice. This is Zaya Wu Daily Finance. Follow for more on global markets, technology companies, and the forces behind capital.